Hello and welcome back to the value-added tax small lecture here on this channel. And as you see from the overview here, today's topic is the last criterion of the 5 requirements which must be fulfilled so that a tax transaction can be regarded as taxable transaction in the inland. So things must happen in the inland from the view of VAT, because if they happen in another country of the EU, then they would be taxable in that other EU country, or if they happen from the view of VAT completely outside the territory of the European Union, then it might be that another state could levy a tax. Although then we cannot prognosticate what will happen, because the other states outside the EU can design their value-added tax legislation completely freely, so we don't know how they are going to do it. So there we cannot even have a reasonable guess, only say it's not taxable within the EU if the place is outside the EU. But now the first strange surprise is probably that inland under VAT law is not exactly what you expect from general rules, because the term inland is specially defined in paragraph 1 section 2 USDG, so of the German Umsatzsteuergesetz, and it's defined in a slightly deviating way from what is generally regarded as German inland. The law says that inland for VAT purposes means the territory of Germany without the areas of Heligoland and Bösingen. Heligoland, you know, is a small little island in the North Sea, which has been for a long time already exempted from indirect taxation completely. Probably originally because it was far too complicated to establish a functioning VAT collecting system on such a small island, which had so excellent opportunities for smuggling. So it's rather traditional, and it's a kind of a subsidy for the inhabitants of Heligoland that they can live without VAT on the goods which they use. The other small municipality which is exempted from the German VAT territory, and just to add that, also from the German customs territory, is the small municipality or village, or I don't know exactly what it is, of Büsingen. This is a municipality which belongs to Germany, but is situated completely within Switzerland. So that small piece of land is completely surrounded by Swiss territory, and so nearly everything probably which they sell or which they buy is a cross-border transaction. And so it would have been very bureaucratic and complicated to set up a customs border around Büsingen, in contrast to probably only a very small amount of revenue. And so I believe Germany decided to renounce on the collection of VAT in Büsingen completely, and to renounce on setting up a customs border. That was probably the most economic decision. And that is why Büsingen is regarded now as not belonging, from a technical point of view, to the territory of Germany. That automatically leads to the conclusion that everything which happens in Büsingen cannot be regarded as taxable under VAT. Good. Another provision is also rather surprising. The area between the border on the high sea and the coastline, the strand, is excluded from VAT inland. Now, the surprising thing is that you and I probably had never regarded the border as being something on the high sea. But under international law, yes, it is the case that not only the land belongs to a country, but also the immediately adjacent part of the sea, 12 miles or even a bit more depending on the international law situation. So the border of Germany under international law runs on the high sea. And now imagine there is a tanker with oil coming down, let's say from Norway, and is on its way to South Africa. And now that tanker comes near to the strand, comes near to German land. Let's say the distance to the strand line is only 9 miles. Then that tanker would have entered under international law German territory. So the whole contents of the tanker would have to be declared for importation. And now imagine half an hour later, the tanker again leaves the German waters. So everything on the tanker's board would have to be declared again for exportation. Customs officials would have to enter the tanker when it enters into the German territory on the high sea, and later they would have to leave it again half an hour later, because once the tanker is again on the high sea, it becomes the territory of the flag state, and then German officials would no longer be allowed to stay on board, so they would probably have to jump overboard suddenly. And all that for, in the end, no tax, because first imported, then exported, and the owner of the tanker is an entrepreneur. So every VAT which was paid by the owner for business purposes, or more correctly for purposes of the entrepreneurial activities, would have to be refunded on application as input VAT. So regarding the high sea border as the decisive limit or border for VAT purposes would be just making things unnecessarily complicated. And so, to simplify matters, the German VAT Act, and I think also the customs legislation, says simply we ignore all the parts of land, all the parts of the German territory on the water. We just regard Germany as beginning at the coastline. So all ships crossing German seas can be safely ignored, can legitimately, without problems and bureaucracy, pass German waters, so that we don't need to have importation and exportation procedures. Because, if that had not been written down there, then everything which is written down in the law must be taken seriously. And then if the rule says everything which enters German territory has to be taxed with importation tax, and there has to be a border control, then that would have to be taken seriously, and so they would have had to install a border control somewhere on the high sea, where German territory begins under international law. That is absolutely impracticable, and so you had to modify the wording of the law in a way that a practicable solution comes out, because you as an official can't modify the sense of the law on your own. The basic principles of taxation demand that there shall be no tax without a legal rule, but on the other hand, wherever a legal rule applies, that then tax must really be collected. So the only way out of that dilemma was to modify the legal rules and to say, okay, the German part of the sea is not a part of Germany for VAT purposes. And now, with a similar background, you can also explain the last exception, the German ships and aircraft in territories which belong to no other country, because under international law, a German ship, so a ship under German flag or a German aircraft, which are in the territory of no other state, count as German territory. But this would again make customs procedures and VAT collection highly complicated. Imagine you sit in a Lufthansa aircraft and you start at Frankfurt, then you are in Germany. Then you fly over France, then you are in France, then you fly over Spain, so you are in Spain, then you cross Portugal, and then you reach the high sea, and then you are in Germany again. And later, for example, you enter into the American territory, then you are in the USA. So it would be complete nonsense to establish a customs control during the flight. And just to make that legally safe, there is this additional explanation or rule in the German VAT Act. The consequence of this is automatically whatever happens in these parts of the German territory is automatically disregarded for VAT purposes, because when you read the VAT Act, it is deemed to be not in Germany. So if on Heligoland you sell something to a customer, well, you are an entrepreneur, a shopkeeper, you act within your entrepreneurial activities, you demand a consideration because you charge your customer a price, you make a delivery, but it's not taxable because it's not in the inland. Heligoland has to be seen as not belonging to Germany. And by the way, it will also not be taxable in any other member state of the EU, because no other member state of the EU will dare to regard Heligoland as Spanish, France, or Irish territory. So no other state also raises a claim. So you can see they will be completely free of VAT in that case. By the way, other countries have similar parts of their territories which they included from the customs and VAT territory for similar reasons. There is a list of them in Article 6 of the VAT Directive. For example, the Canary Islands are disregarded by Spain. So whatever you buy in the Canary Islands is not taxed under VAT. And even when you return from the Canary Islands to Germany, you have to pass a customs border, because the Canary Islands are regarded as a non-EU territory for VAT purposes. By the way, the same applies if you buy something on Heligoland and then bring it back by ship to the mainland. Then you have to pass through a customs control, and the goods which you bring, let's say to Hamburg or Wilhelmshaven or so, will be charged with VAT on importation when you cross the border. Yeah, so that's the first surprise which you must know or could notice and should notice when it comes to the term inland under VAT. Naturally, there are also some technical terms for the rest of the world. For example, when we speak about community territory, then that means the total of all VAT inlands of all EU countries. If you mean everything which is customs territory or VAT territory of the EU, without Germany, you speak of the remaining community territory or the rest of the community territory. This is everything which is VAT territory of the EU countries, but without the VAT inland of Germany. And there is a very frequent term, third country or third territory. These are all territories which, under the perspective of VAT, do not belong to the inland of any EU country. So, where the EU VAT rules don't apply. So, Heligoland is not a part of the German inland for VAT. It's also not a part of any other EU territory, so it's a third territory. Switzerland is a third country because it does not belong to the EU. So it's automatically third country. The same applies to the EEA states, so the 3 states of the European Economic Area, because these 3 states have decided to take over nearly the complete business law legislation from the EU automatically, but they explicitly excluded tax directives. So all the VAT rules of the EU do not apply to the countries of the European Economic Area, and therefore Iceland, Liechtenstein, and Norway are to be regarded as third countries for VAT purposes. And naturally, such countries which have nothing to do with the EU, like Russia, China, Egypt, Morocco, South Africa, and now I could go on and could bore you for a time with a list of countries. All these countries are third countries, naturally. The Canary Islands, you remember that, are a third country because although they are a part of Spain, for VAT purposes, they are excluded from the Spanish territory. That has the same reason as with Heligoland. One perhaps wants to subsidize the inhabitants and to make the cost of living a bit lower as a compensation for that isolated location in which they live. Yeah. What I did not yet mention is a very special situation. You will also see in your VAT Act that under the perspective of VAT, the Principality of Monaco is to be regarded as a part of the French territory. And that might be surprising because Monaco is a third state, and Monaco does not belong to the EU and not belong to the European Economic Area. So in principle, they are completely out. But due to an agreement between France and Monaco, the Principality of Monaco always takes over the VAT legislation of France in completely identical form. That has been introduced so that they can leave the border open and that they need not to establish a customs control between the border of Monaco and France. Because if they were to force a customs control at the border, then probably the economic situation of that little principality would completely deteriorate, and although wealth would break down, at least traffic would be held up in an enormous jam. And so they asked the French to leave the border without controls, and the French made it as a condition that then, in order to safeguard the neutrality of competition, that this was only possible if the Monegassians were willing to apply exactly the VAT rules which are valid in France. And so, when the European system was introduced, then everyone had to regard Monaco also as a part of the French VAT territory. By the way, what I personally absolutely do not know is if the Monegassians then even pass on a part of the revenue to the French, or even if the French administration is responsible for the taxation of the Monegassian shops and businesses too, or if they have their own fiscal administration. I have no idea as to that, sorry, but it's rather a curiosity. So when you hear about Monaco, it's not a part of the EU, but due to special arrangements with the French, they take over the French legislation in Monaco, and so every other EU state has to regard them as a part of France. And if they take part in cross-border trade with other EU countries, they even get a VAT identification number, which is issued by France or which is identical to the ones which are issued by the French system. Good. Now, let's think about how one tests if something happens in the inland. And now, surprise number 2, a big one. Normally, if somebody does something in Germany, you would automatically assume then it's done in Germany. And VAT's law says that's far too easy. We are going to make things a bit more complicated, and we establish some completely different ideas. So let's have a closer look on that. You and I would just look to where in geography something happens, but now the approach of the legislator was completely different. You probably can understand it from the historical development. Let's say in the beginning, when the world was still simple and plain, and there were no cross-border contracts, they just set up a rule. Everything is taxed, which happened in the inland, and that was perfectly clear. Later, when cross-border activities began to arise, and sometimes you had to decide about things like, do we really want to tax something where, let's say, a haircutter from the Netherlands once in his lifetime visits a German customer at home in Germany, cuts customer's hair, and then walks back for 20 euro. Do we really want that, or do we want to ignore these cases? Or on the other hand, if a German haircutter who has established a shop here in Germany once visits a sick customer in the Netherlands at home and cuts hair there, do we really want to accept that argument? Well, this 20 euro revenue was not made in Germany, so I'm not willing to pay taxes on that. Is that exact, but too complicated? So one had to decide if one really wanted to tax that or really wanted to exclude the other transaction. And now one could have modified the basic rule by, okay, taxable are all the deliveries of goods and services made in the inland, apart from the case where a German haircutter once visits a Dutch customer at home, because that also is to be taxed, plus or without cases where a Dutch haircutter comes to Germany once to visit a customer. Then the basic rule would have turned into something which would have been intolerably long. And so somebody came to a very, very impressive idea. They just said, well, we solve it in another way. We just say, whenever we do not want to have tax consequences in our law, we just say, this happened not in the inland. Whereas in all cases where we want to have tax consequences under our law, we just say, this was in the inland. Now, it would rather be strange to say that something where people met in South Africa happened in the German inland. But, well, the legislator is very, very self-conscious there. Is it self-conscious? At least they are very much convinced of themselves. They say, well, I am the one who writes the law. If I say that red is blue, then red is blue. And if I say a certain transaction which people think happened in South Africa, in reality happened in the middle of Hamburg, then it is my word which counts. Naturally, that is nonsense of a higher level, but it's a kind of a fiction. So whenever they want to cover a transaction, they just say this has to be seen as happening in the inland. When they want to ignore it, this was not in the inland. You have even seen the most daring trick of all of them. Everything which happens in Heligoland is not in Germany. That makes dealing with all Heligoland cases plain and simple. They can be ignored. They can even not pass the first test. They didn't happen in the inland. Now, what happens? What if the legislator wanted to tax one specific transaction, although it happened on Heligoland? Well, there would be a simple way out. Just say this transaction didn't happen in Heligoland, but in the middle of Munich. So here we work with fictions. The place of delivery or the place of supply is basically completely fictitious. Sometimes it gets along or it is in line with what physically happens, but that is rather coincidence. The idea is not that the legislator looks what happens in the inland and then decides to declare it taxable. The logic is just the other way around. Do I want to tax that? If so, I declare it to happen in the inland. Do I want to ignore that? Then I declare it to be outside the inland, abroad. That is something which you necessarily need to understand, because without checking the place of supply of a service or a delivery, you can so never be sure if something is taxable or not. You can never trust your common sense. So if you meet somebody walking around and constantly asking with a confused face, where am I? This is either somebody who suffers from dementia or somebody who works on a VAT case, because in a VAT case, without looking into the rules, you never know where you are at the moment and where you are doing something. So you always need to check the rules, because the legislator here just has exactly the logic the other way around in comparison to what we would expect. Good. So we can never say if something happens in the inland or not. There will be a mass of rules with which you have to become familiar in the long run. Let's at the beginning just mention the most frequent ones. In case of a delivery, there are rules in paragraph 3, sections 6 to 8, paragraph 3c, and paragraph 3e USDG. In case of a service, you have rules about the place of a service in paragraph 3a, 3b, and 3e USDG again. And in case of a so-called intra-community acquisition of a good, that is in 1.1 number 5, a special additional rule where things can also become taxable. They are the rules about the place of an intra-community acquisition of a good, determine if it is taxable in the inland or not. That is paragraph 3d. So you have a mass of different rules. There is also something on importation of a good. That is, for reasons of convenience, just taken over from the customs duties rules, because customs duties and importation VAT are collected by the same people, by the same procedures, and at the same places. So one just takes over here the solutions of customs rules. Well, if we look to the general rules a bit, then there is a distinction between the place of delivery of the good with movement of the good, so with a dispatch or transport. So if a good is sold and then either the seller brings it to the customer or the customer comes and fetches the good and carries it home, then in all these places, the place of delivery is deemed to be where the movement or transport of the good towards the customer begins. So if the seller begins to carry the good towards the customer, that place where the movement begins is the place of delivery. If the customer, for example, goes to a supermarket and buys some apples there, the transport of the apples towards the customer's destination begins in the supermarket at the cash desk. From there onwards, the customer carries the goods home, so also there would be the place of delivery. There are some rare cases where a good is sold without being moved. For example, if you buy a house, or if you buy a piece of land, or some other imaginable rare transactions can happen without movement of a good. In that case, the rule for the place of delivery says the delivery then takes place where the good is at the moment when the ownership-like position changes from the first owner to the second. So it does not count where the people are at the moment when they write the contract and declare to fulfill it, but it entirely depends on the place where the good is at the moment where ownership is changed. So that really has the consequence that if two people meet in Switzerland in front of a Swiss notary and they sign a contract by which they sell a piece of land, that the transaction which the two do would perhaps be in Hamburg, because if the building sold or the piece of land sold is in Hamburg, then paragraph 3, section 7 says the place of delivery is where the good is at the moment when ownership changes, and a piece of land in Hamburg naturally is in Hamburg when ownership changes. Yeah. Now, when it comes to the place of a service, there is the need for simplification is relatively strong in that area. And so the basic rules here are, if the customer is a private person, then all services to private customers shall always be regarded as happening where the supplier of the service, so where the entrepreneur has established his or her business. 3a, Section 1 USDG or Article 45 EU VAT Directive. The reason is this is the only practicable solution which spares the people bureaucracy. Imagine a haircutter's shop where a customer works in, and that customer comes from the Netherlands or from Belgium. Then the haircutter would always have to find out where the customer comes from, if the destination country counts and such things. And if the haircutter really once travels to visit a customer at home 5 kilometers beyond the border, this one single transaction does not justify the increase of bureaucracy which one would have if one would tax that single transaction in the other country. So the most simple rule is just let's tax all these things at home where the supplier runs his business. A different solution is possible and practicable in cases where the customer also is an entrepreneur. In that case, one usually writes an invoice, so you know customer's address. And under the principle of taxation in the country of destination, it is then recommendable to give the right to levy the tax to the customer's country. In cases where that leads to a very strange result that might happen, well, nevertheless, nobody really bothers about it, because if that rule leads to a place of supply, which is rather surprising, does it really matter which country gets the VAT and then a minute later has to refund it to the business customer? Probably that doesn't really matter. So even if a very unconvincing result might come out under that fiction of 3A2 or Article 44 VAT Directive, usually one sticks to that solution. Well, these are only basic rules, ladies and gentlemen, so there will be specific rules for special cases where one deviates from them. Usually the justification for these specific rules is that the basic rules would lead to practical problems or to problems with the neutrality of competition in some specific cases. So then one would deviate from them. For us as beginners, this is a good start if you memorize these 4 rules here and begin to play with them when it comes to case solutions. Naturally, later we will work more in detail on the place rules, but for beginning that might be sufficient. Good. Let's sum up the most important things. You can never decide on your own if something happens in the inland from the VAT perspective or not. You have to check the rules, place of delivery or place of service. And naturally, that makes it important to determine first if you have to do with a delivery or with a service, because from a logical point of view, you cannot look for the place of a service before you are sure that you really have to do with a service. Okay. So the question in the inland or not requires to check the place of supply. The place of supply of a delivery or the place of a delivery. That means the basic rules here are first, if the good is transported or moved in any way from the seller's location to the customer, then where the movement of the good begins, there taxability arises. So there, the seller either has to pay tax or to prove a tax exemption. If something is sold without any movement of the good in connection with the sale, then the place of supply, the place of delivery is there where the good is at the moment when ownership changes. The place of supply of a service, that was basic rules. If the service is made to a private consumer, then where the supplier, so where the entrepreneur runs his business. Or if the service is B2B, business to business, instead of business to consumer. So if it's B2B and the customer is also an entrepreneur, then 3A2 says then the place of supply of the service is where that customer has established his business. So that would be, in most cases, the country of destination. Good. If you not forget that, then you can already be proud. So we have now got a first impression of what taxability means. And naturally, the next chapter which we have to talk about will be tax exemptions, naturally. And we will have to deal with that, as you can imagine, in the next small video. So thanks and goodbye for watching this one. Recover well from this one. And don't forget to come back. Thanks for watching. Till next time.